Welcome to TheoTrade. This is Don Kaufman. Here we are. It's February 22nd, 2017. I am doing the Theo Night video with just about 2 minutes left to trade in the day. The S&P futures are massively unchanged on the trading day. As you can see right up here, the S&P futures, they're going to close, well, for the most part, unchanged, up about a buck or so. And the Nasdaq futures also largely unchanged. The Russell dipping ever so slightly in kind of a mixed bag of goods trade today. It's been a relatively slow trading session, even though we did have FOMC minutes. So, you know, in slower days like this, I take a little bit of time. I start doing a little homework, a little research in the market, and I'm going to take you into some of that homework, some of that research over here. So what's on everybody's mind lately? It happens to be implied volatility. All right, I'm going to go ahead and I'm going to close up this left side bar. Again, the futures are literally going to change completely to zero at the close, the bell over here. But when you take a look at the SPX, I'm going to start with the SPX. You know, it's not a far stretch to say that implied volatility, and implied volatility is really what justifies an options, pricing and its option risk. But implied volatility is incredibly low, and it's been inherently low for an extremely long period of time, no matter what underlyings we want to look at. So what we're looking at right now happens to be, again, the SPX, which is the S&P 500, and down below here in the chart is specifically the implied volatility for the SPX. This is about the 30-day implied volatility, hovering, well, extremely low, in and around the 12% range. But more than just looking at today's implied volatility, what's the implied volatility ultimately been doing, okay, and where is it right now versus the previous year? And that is something that we often call IV ranking. So when I say IV ranking, it ultimately ranks wherever implied volatility is right now versus where has it been, okay, in the previous, for example, 52 weeks. And the answer is, well, it's towards the lower end of that range. But we can actually come up with and we can quantify exactly that. And, here on thinkorswim, it's called like an IV percentile. It's also known as an IV rank. There's the bell. You really don't need this specific number, but the IV ranking right now is about 14%, which just means, okay, when we go back over to the chart, there's very few occurrences of implied volatility lower than what we're currently seeing in the last 52 weeks. But I started taking this out much further. Okay, I started looking like over the last 5 years, and you can see there's only maybe 10% of occurrence of volatility under where we're currently at. And then I took it even further than that. You can go to like 10 years. You can go back 20 years of data. You're not going to find too many occurrences of implied volatility this incredibly low. And, where am I ultimately going with this? Number one, this should dictate to you, what types of strategies you might want to employ. And I'll give you an example out there. So I get an email and somebody says, I want to go out and I want to sell naked puts. And for those of you unaware of selling naked puts, sometimes people go out and they'll sell a naked put because they want to buy a stock, or they're trying to sell a naked put because they think they're going to get away with something. But you'd have to realize that you'd be selling options naked. It doesn't even matter what underlying. For the most part, you're selling options naked in one of the lowest recorded volatilities in the history of this business. I mean, how does that strike you? Forget about direction for a second. Low implied volatility. Does it mean the market's eventually going to tank? No. But I'll tell you one thing. Eventually, the implied volatility will go up, eventually. But the low implied volatility, there's nothing that denotes that low implied volatility leads to the market eventually tanking over there. Nevertheless, you have to look at this from a statistical standpoint and say to yourself, do I really want to sell option premium in one of the lowest recorded volatilities? And to me, the answer is absolutely not. The opposite happens to be true. And again, I built most of my career around selling options. I'm a net buyer right now. For those of you that know what this means, I'm a net buyer of premium. It means I'm long gamma. I'm actually long gamma. Okay. So moreover with that, I also ran a scan. So I scanned the entire S&P 500. Why did I like to run these scans and kind of scrub the entire S&P 500. It's stuff that's, again, not necessarily even liquid. Not everything in the S&P 500 per se is liquid, but I wanted to look in the S&P 500 for IV ranks between 50 and roughly 100. So what does that ultimately mean? Well, it's in the upper, cusp, if you will, of implied volatility. So implied volatility, the way it kind of ranks, if here is the 50% level, okay, you can go down here. This is like your 0%. Way up here is the 100%. And as volatility oscillates, it's always falling in one of these kind of quadrants. But here's what's kind of amazing looking at this IV ranking right now is that in the entire S&P 500, there's only 38 products that even rank above the 50th percentile. Okay? There's only 38 products out of 500, and by the way, there's actually 501. Google is split into two halves, right? But there's, basically in 500 stocks, only 38 products even above the 50% kind of ranking out there. And most of them even have earnings on them, okay? The other irony is all you have to do is glance at this and you're actually going to see Urban Outfitters, Ulta, it's all retail stuff. Everything, Nordstrom's over here. It just goes on and on and on. Dollar Tree, Dollar General, okay? Retail apparently is not doing very good. Kohl's is on this list. And I say that because if you look how high the implied volatilities are, they stick out kind of like a sore thumb in this case. Why? Why do they have high implied volatilities? Because generally speaking, these stores have been tanking in the marketplace. So what I'm actually showing you is, number one, if you're going to go out there and you're going to sell premium, please be checking the IV rank. But know that overall, inside of the S&P 500, that there are very few products indicating risk. Okay? And you have to actually stop for just a second and big picture stuff here for just a moment. Sure, you got some retailers that are tanking out there, but we keep, hearing online sales are getting better. Okay. Listen, there's really one online retailer. It's called Amazon. Okay. It's, whatever benefit there is, it's all to Amazon and everything else is getting killed out there. Nevertheless, the big picture over here is a very, very simple one. Okay. You're not getting paid. If you're selling option premium, you're not getting paid to take risk right now. And when you look out, and just, do me a favor and step away sometime from looking at every single tick of the market. When you step back from the market and you look at 1 month, 2 months, and 3 months out, do you not see risk? Think of it it's just a myriad of risks that are prevalent, every single day in this marketplace, whether it's geopolitical risk, whether it's, European political risk, which is coming right now with French elections over there. We're all of a sudden talking about bailouts again. All right. We don't even know what our own tax situation looks like here in the US through the end of, the next week. There could be a tax program that's announced that could be, for or kind of against markets. Nevertheless, here we sit with a VIX at 11.7, okay? Very few products in the S&P 500 even rank above 50% in implied volatility, okay? Keep your wits about you in this marketplace. You must know what your risk is, okay? And plot your risk, okay, as if we're going to make a 3% move in this marketplace. Not exactly a warm and fuzzy feeling I'm leaving you with here this evening, but this is the reality of the business. When it's quiet, when you have a little bit of time to reflect out there, reflect on what matters, and that's your risk, okay, and your overall strategy and your trade logic. Not going to be a big premium seller, and right now, okay, this is the time to quantify exactly what your risk is, not when we start to get volatile. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.